why the bond market matters to stock investors. Today, we're going to talk about European bonds, Canadian bonds, US bonds, and finally, we're going to talk about some economic factors and why all of this matters to those of us who invest in stocks. At the end of the video, we're going to talk about the value trend plan to deal with all of this noise. My name is Keith Richards. I'm President and Chief Portfolio Manager of ValueTrend Wealth Management, and this is the Smart Money, Dumb Money Show. And yes, I do have my pants on. All right, we have quite a few charts to go through today, guys, so I'm going to try to rip through these charts as efficiently as possible. Now, I've talked about this on the show before, and that is that North American bonds are getting debt downgrades. Now, everybody's pretty aware of the U.S. situation. U.S. just lost its AAA rating. Fitch downgraded from AAA to AA+. Well, that's kind of been out there, and it's caused a bit of chaos on the bond markets in the US, but it's happening in Canada too. In fact, Fitch hasn't downgraded us, but Canadian bonds, which are currently AA+, which is the rating that the US just got, Fitch is saying that based on the current Liberal plan of increasing Canadian deficit by another 20%, they're going to probably downgrade our debt, and who knows to what, but let's say from at least AA+ to AA. So this is not good news to bond investors in North America and for our currencies. I want to focus more on the US bond market right now because generally speaking, the US is the largest bond and stock market in the world. So we want to look at what's been happening on those credit downgrades that the US has been seeing. And what we're seeing is that foreign buyers, which are a big chunk of U.S. Treasury auctions, are falling out of bed. The auctions in April and May were weaker than expected. Now, the problem with that is that this year, 2025, there's nearly $3 trillion of gross new bonds that are going to be issued. So, let alone what's got to be rolled. So, with recent weakness on the bond markets, this should be of concern to us. North America is not alone in this problem. In fact, Europe, led by Germany, is radically expanding its fiscal requirements. In other words, they want to print money too. And it's like nobody seems to learn the lessons here. France is going to be printing so much that they already have a record deficit of 5% of GDP. Canada is sitting at a record debt to GDP as well, 2%, all-time high for us. But France beats everybody in this regard. This chart shows us historic fiscal adjustments versus current fiscal stimulation plans by various countries through the European Union. And you can see across the board almost, big changes are coming. These guys are going to be going from fiscal prudence to fiscal expansion, printing money hand over fist. And you can see where that got Canada and the United States. In fact, Britain's been here before. So, interesting to see. Well, with all of this fiscal stimulation, whether it's the big, beautiful tax plan in the US that Trump just put out, or Mark Carney's spend plan for the next 4 years, this is creating some economic policy uncertainty in US and North America. In fact, fiscal policy uncertainty is skyrocketing. Analysts are concerned about what's coming next. Because of all this, 10-year bond premiums in the US are extremely high on a relative basis over the past number of years. Now, what a bond premium is what the yield is on a 10-year bond comparative to a 30-day T-bill. The spread is that premium that you get by buying a 10-year bond. Now you can see it's been climbing like crazy. The 10-year auction is having to roll at much higher premiums compared to the 30-day T-bills than it has been over the past couple of years. And that's a concern because higher yields cost the government more. So let's get into why all of this matters to stocks. Well, what we've got here is the 20-year TLT ETF that we own actually a small position in it, ValueTrend, and the S&P 500, which is the red line. And what you'll notice is that generally speaking, they move roughly together. And typically, if they start moving in opposing directions, the jaws will close and they come back together again through a correction on one of the indexes or the other. Well, that's what's happening right now. In fact, we're seeing the S&P rising over the past 3 years, whereas the bond prices of TLT have fallen. I like to call this the jaws of the relationship between stocks and long-term bonds. Sooner or later, those jaws close and the relationship goes back to their historic pattern of being relatively close in performance. What that means is that either stocks will decline or bonds will rise. Keep this in mind as a stock investor because this relationship is likely to change soon. Here's a chart that I've shown you guys before. This is the momentum guidance by CFOs and CEOs of S&P 500 stocks. And you can see that guidance has been heading down for forward earnings. The conference calls come out and they adjust their earnings a little lower. That's not necessarily good for those of us who are hoping for a higher stock market. Now, I'm going to give you a reason as to why that matters compared to bonds in a second, because there's a little formula that I'm going to teach you guys to keep an eye on to spot valuations on the markets on a relative basis. So first we need to know what the 10-year US Treasury bond yield is. Now, what I want you to notice on this chart is that the 10-year Treasury bond has been moving up since March. Now, what's really interesting, though, is that the MACD indicator, which is a momentum indicator, began moving up ahead of that trend up in yield. And you can see the last time this happened was late 22, where the MACD began moving up ahead of the Treasury bond yield moving up. So there is a potential that we will see this old high at around 5% on the 10-year bond taken out or at least hit in the coming months. So now we're going to talk about something called earnings yield on the S&P 500, and then we're going to compare it to the 10-year Treasury bond yield, and we're going to discuss why this matters. So if we look at forward earnings, which are just estimations by analysts, the current expected forward earnings in 2026 is $269. Now the market tends to look a year out whenever it's pricing. So if the earnings are going to be $269, we can calculate the earnings yield. Now, something I want you to keep in mind though, which is, do you remember that earnings momentum chart we just looked at? Well, the earnings momentum chart is heading down. In other words, the momentum of earnings growth expectations coming out delivered to us by CEOs and CFOs from different corporations are shrinking. They're expecting earnings to not go up as much as they expected as they report their quarterlies. So we're using a number that stands as of about a week ago when I got the current consensus number, but that could change if that other chart continues heading down. Whatever the case, we're going to use $269 for forward earnings, and we're going to use the close from May 27th. I'm recording this on May 28th, and that was 59.21. It'll be different by the time you watch this video, but what I want you to see here is the concept we're talking about. So we know we have $269 in forward projected consensus earnings, and we have 59.21 for the current market close. So divide 269 by 591, multiply it by 100 to make it a percentage, you get 4.54%. Okay, let's call it 4.5%. Now what we do is we compare that percentage, which is called the earnings yield, to the 10-year treasury yield. Okay, currently, as of this morning when I woke up on the 28th, the 10-year yield on U.S. Treasury bonds was 4.47. I'm going to call that 4.5%. So they're basically the same. The earnings yield is 4.5. The Treasury yield is 4.5. Here's why this matters. Because if Treasury yields go ahead of or above earning yields, then we have a situation where the bond market is actually more attractive from a risk-reward potential than the S&P 500 or stocks. So we really want to keep our eyes that on the 10-year Treasury yield and on S&P earnings. Now, as we just saw, there's a tendency for yields to be going up right now. There's a tendency for possibly earnings projections to come down. So we have like the worst potential storm coming if either or both of those situations happen. So that indicates that the market could become at least overpriced. At this point, it's maybe fair, but it's walking on thin ice. So again, I want to caution you to consider the falling bond auctions, the rising yields, and falling earnings momentum. These factors matter. There's no sense predicting what's going to happen in the next 2 weeks, but I don't think there's a huge tailwind for markets to rise on fundamentals right now. They're strictly moving up on technical. So what's my plan? Well, here's what ValueTrend's been doing. We're still holding some cash. We're holding about 23 or 24% cash right now. We have moved that down from well over 30%. Why? As you guys know in some of my previous videos, ValueTrend has a rule. If the market moves above the 200-day moving average, we buy. But we're buying very selectively. We will continue to do so, but we'd really like the next step of the S&P breaking above its old high, which is around 6150 or so. So we're holding cash. The stocks that we are buying are value stocks, and we really like hard assets. We like gold. We like silver. We do like the metals. They're just starting to move right now. We like agricultures, like fertilizers. We like energy, specifically nat gas. So there's other commodities too you can look at. The point is, you've heard me talk about these assets in past videos. So there's an argument that can be made that says that we should buy assets that are not wholly correlated with the stock market because things may change, as we just saw on some of the charts. The last thing I'll point out is that you can trade within any market. So just because the view that you might have is bearish for the S&P or neutral for the S&P, and I'm relatively neutral on the S&P right now. So because of that view, it doesn't mean that I stay out of the market entirely. There's lots of trading going on. And in fact, I want to bring to your attention that we are going to record the day in the life video on Friday of this week, which will be the 30th. And I hope to have it posted by this weekend. So I do hope that you get a chance to see the day in the life video. It'll feature myself and Craig. And we actually are going to record a brand new series of trades that we just went through in the past couple of days. So I think that you guys get a lot out of this because we're going to sort of go over what we did in order to buy these stocks live and in Technicolor, because these are actually brand new trades. So I hope you're going to tune in for our video that will come out this weekend, a day in the life. It's going to be a good one. And don't forget, like and subscribe to this video channel. Remember, hashtag Raise for Rebecca. See you next time. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at ValueTrend. And by the way, I don't just talk the talk. I walk the walk. I have been a portfolio manager for 35 years. And in fact, I was one of the very early pioneers in technical analysis here in Canada. on my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk, spam, and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a long-time portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.